Okay, it is Monday before the US midterm elections, and we got a bunch to go over in this video. I'm excited to share with you guys a major change I made in my portfolio. I moved thousands of dollars around, but first we need to talk about the economic news of the hour. So the major catalysts and news for the market this week is twofold: the midterm elections and the upcoming inflation report on Thursday. Tuesday's midterm election will determine which party will control Congress and impact the direction of future spending, which is very important during a high inflation period. On the economic front, investors are anticipating that Thursday's CPI report will give more insight into the Fed and this whole tightening cycle. Okay, so let's talk about the midterm elections first. And this is what you need to know. The S&P 500 has historically rallied after midterm elections. Stocks especially like if the midterm election results in a divided government. And this is key. The reason why the stock market performs best in a divided government is because nothing gets done, and that's extremely predictable. And here's the current polling for the midterm elections that are going down tomorrow. And it's a very close election. Republicans are favored to win the House, and in the Senate, it's a complete toss-up. So when you combine this with the fact that the president is still a Democrat, it's most likely going to lead to that divided government that stock markets historically like. Okay, now let's pivot to the economic, and more specifically, the inflation data coming out on Thursday morning. So according to the economists surveyed by Bloomberg, the predicted headline CPI annual rate should be 7.9% for the month of October. So that's the number right there, 7.9. Extremely important. If the number comes in above that, the stock market is probably going to tank, and if it's below that, that'll be great news. And just so you know how this compares to the previous months, it's not a big deviation. So September was 8.2, and the peak was 9.1 back in June. So if it is indeed 7.9, it will continue the slight downward trend. But remember, the number itself isn't that important when it comes to the reaction of the stock market. It's all about the expectations and whether or not we're above or below that number. And I think it's important to remember that the actual economy is a real thing that we should be considering. And the third quarter, the GDP did grow by 2.6%, beating expectations after 2 consecutive quarters of declines. So that's great news for the actual economy. And currently the unemployment rate is 3.7%. We can see how it's been trending here. And it's nothing super alarming quite yet, even though we have all this talk of a recession coming potentially next year. And for the housing market, this is the data on the median sales price of houses in the US. And we're also not seeing any downward trend quite yet. Okay, but it's time to show you guys the major changes I made within my portfolio. Now, I guess I should preface this by saying that the overall strategy hasn't changed, but I tried my best to simplify my approach to maximize my odds of having good returns. So I still have it split up 3 ways. I have the broad market S&P 500 assets, I have my value/dividend assets, and then my growth/technology assets. And within each of these slices, I have 2 ETFs. So let's jump right into the growth section. You're going to notice that both these funds are indeed technology/growth oriented, but the approach is extremely different. VGT is a passive index fund. So it follows a benchmark, it's market cap weighted, and it just does its own thing. BST, on the other hand, is actively managed, and they use covered calls to boost the yield of the fund. So generally they should trade in the same direction, but because the approach is different, they will have different levels of return, different yields, and by having a 50-50 split, I'm giving myself exposure to both strategies. And the same exact concept is happening with the other sections as well. So if I come to the dividend section, I have SCHD, a passive equity index fund, and then Divo, which has covered calls and is actively managed. And finally, if I come to the S&P 500 assets, we have the S&P 500 and then JEPI. So it's a very simple approach, and let me know what you think of it in the comments below. And hopefully, no matter what market condition we're going through, a bear market, a bull market, this portfolio with its 5% overall dividend yield will do at least okay. That's gonna do it for the video. Hope you guys enjoyed. If you did, leave a like, subscribe, and I'll see you guys in the next one.